anything pledged by the IMF is coming out of our pockets. But you can imagine, if you're working to whatever age, and you see someone who's able to retire at 53 or some other number, and they're asking you for a bailout, you could see there might be some resentment there. And certainly we're starting to see that in Europe. Rescues are by no means guaranteed. Despite the pledges of rescues, the market is expressing real doubt that many of these peripheral European countries will escape default. Susan referred to the yield on 2-year Greek bonds near 25%. The yield on Irish bonds is in the double-digit area. And there is no way that these countries can raise enough money on the income side through taxes to pay those debts. It isn't possible. I saw the numbers on Ireland, and I don't remember the specific numbers, but they're almost, the amount due to service the debt is almost the full amount of the money that they are taking in taxes. And this is before spending on any government programs, anything that the government normally does, police, military, whatever. While a default in one of these countries would be distressing with unknowable consequences, the bigger worry is that the problem will reach the larger countries like Spain or Italy. So far, Spain's bonds have been well supported by the Chinese for reasons that are not clear now, but because Spain isn't held in terribly high regard by most of its European neighbors. But China is, for its reasons, doing a good job to keep interest rates on Spanish bonds relatively low, in the 5s, for example. But Spain's stock market has a negative look to it. If you look on page 29, it's hard to find any appreciable difference between the pattern of Spain's stock market and that of Portugal, which just had to request a rescue package to avoid default. They look almost identical. Spain is much bigger, than Greece, Ireland, Portugal combined. Spain is a 500-pound gorilla when we start looking at these potential problems. Default would be a catastrophe to the European and world banking systems. And that's come from international economists and others. Just a few years ago, nobody worried about, or at least nobody worried openly about, countries defaulting. Now European defaults are imminent unless they can convince kind of the taxpayers in the north to rescue, at least temporarily, those in need in the south of Europe. Just a few weeks ago, the rating agencies cast doubt on the U.S. formerly sacrosanct AAA bond rating, saying if we don't get our act together, there is an appreciable potential that our rating will be downgraded within the next 3 years. What we're dealing with right now is not business as usual. Just over 2 years ago, the entire world financial system was in danger of collapse. And that's been admitted by central bankers, by leading investors of the world, and so on. The system had frozen. We couldn't get short-term lending from one entity to another entity. It was rescued from the brink by the largest creation of new money and new debt in history. Massive debts were transferred from the private balance sheets of major financial institutions to the public balance sheet. So you and I and all taxpayers can now count them as our debts. the debts remain. They have not been paid off. And there's no guarantee that the system will survive without experiencing significant corporate failures or defaults. That was imminent 2 years ago, but for the government rescue. The government has thrown new money in, but remember, that goes to the debt side. Thank you very much. That goes to the debt side as well on the balance sheet. So the debts are still there. Stock buyers, with that in that context, should rent rallies, not buy them. Be patient, wait to buy on significant declines. Let me take a quick look before we finish at the fixed income picture. If you look at page 30, you will see this is a bond yield graph. So this traces the yield, not the price, the yield on the 10-year U.S. Treasury note, going back into the 1970s, up to the peak in the beginning of the 80s, and then for 3 decades, with zigs and zags, we have a declining interest rate environment. 3 decades which have been a godsend for bondholders. At current very low yield levels, there's a far greater risk of being wrong if rates rise than being rewarded if rates decline, stay flat or decline, let's say. And you can see that over on page 31. Susan prepared this a week or so ago, so the numbers are maybe a week out of date. But this is the sensitivity of a 10-year U.S. Treasury bond to changes in interest rate. This is a 3.13% bond, which at the time the interest rate was 3.20, and so the price had declined a little bit below par, or at a rate of what you can see here, $994 a bond at that date. So we're considering that our starting point. At 3.13%, each $1,000 bond is going to earn $31.30 in a year. So these are just prices of the bond itself. So if you add $31 to each one of these, you would get the price at the end of the year if, in this instance, if the yield went from, say, the 320 level down to the 220 level. So if you dropped 1 full percentage point from 320 to 220, the price of the bond in 1 year would go from $994 to $1,083, plus your interest of the $31 and something, and you would end up with a 12% gain. And that would be wonderful. On the other hand, if interest rates went the other direction, from 320, let's say, to 420, your bond price would go down to $913. You have to add your $31 and change in, so you'd have a total of $944 after a year. You would have lost, including the income you got, you would have lost 5%. On the other hand, if it went up, 2% from 320 to 520, you'd be at 840 on your bond after your income. In 1 year, you would be negative 12.4%. If it went as much as 3% up from 320 to 620, you would be down 19.1%. I put that in as an example only because many people have said, well, in an environment like this, why not just grab some yield, buy a 3% 10-year? Well, yes, that's fine. And if you hold it for 10 years, you will get that $31.30 per year, and your price will be par 10 years from now. What you can't know today is what that would buy. If the fears of severe inflation, which I admit is an open question, it's not It's not, I mean, the tendency when anybody creates lots of new currency is that prices go up. So inflation is the logical extension of this policy of money creation. But as pointed out in some of the earlier graphs, when you have unemployment in the position it's in right now, that inflation isn't guaranteed. We might not get it, but we might. And that's the fear that every bondholder should have. If, for example, and can you go back one page here? If, for example, the last time we had really serious inflation in this country, Paul Volcker was the chairman of the Federal Reserve, and Paul Volcker pushed interest rates up to here. Now, what I just used as an example where you'd lose almost 20% in a year would be if interest rates went up to, I can't read those things over here, about here. If it went up here to here, you would lose 20% in your first year. Clearly, there's an awful lot more room above than below these interest rates. And I'm not saying don't go buy bonds. That's not my message. It's just don't go buy bonds with a calm about you saying, well, all's going to be right with the world, because it might not be. There's clearly a real other side to that potential. We're living through the greatest government financial intervention in history, clearly. About 3 weeks ago, Fed Chairman Ben Bernanke, you can scroll forward to, took credit for the success of that QE2 program with the quote that you have here. I do believe that QE2 was effective. We saw increases in stock prices. Now that's not what he said QE2 was designed to do, but it's what happened, so you might as well say thank you very much. He made no reference to the monumental debt load he's heaped on the backs of generations to come. If we look at the performance of the stock market over the past 2 years, it's apparent that investors have adopted an approach voiced by another famous American. I can't think about that right now. If I do, I'll go crazy. I'll think about that tomorrow. So with that, I'm going only 5 minutes over, which is monumentally good for me. And we invite you to stay, enjoy some food. I would be happy to, as long as the voice holds out, I'll be happy to talk and answer questions too.